Yeah, we've been using a strategy of trying to look for names that are going to get to the other side of this. And that sounds easy, but it's not. There are companies that have too much debt that may not make it to the other side of this. As compared to 2008, when we thought the whole banking system might get nationalized and go under, we really do think you can see the other side of this. And it's only a question of whether that's a couple of months or 6 months. So it's buying names that are under a lot of pressure in these conditions, but are going to be fine in the long run.
Like what? Which names? What are you talking about?
Well, so, the name we talked about probably the most on the show is KKR. The stock went from 32 to 17 during this last month, and the fundamental business wasn't really hurt at all. They have 10-year lockups on most of their funds. They get paid 2 and 20, 1 3/4 and 15 sometimes, but that business is going to be fine, and yet the stock acted like it was going out of business. So Blackstone went from 60 to 30. I mean, there are great businesses that we've been adding to because they're going to be fine on the other side of this.
Well, a growing list of companies are suspending capital programs like dividends and share buybacks as they try to preserve funds amid growing economic uncertainty. Added to that list today, Nordstrom, Intel, and Chevron. Intel and Chevron both suspending their buyback programs, while Nordstrom halted both dividends and buybacks. Chevron CEO Mike Wirth joined CNBC earlier today, explained the company's decision to preserve the dividend.
Our dividend is our number one priority. It's very secure. We haven't cut the dividend since 1934. And we come into this with a position that is stronger, really, than just about anybody in our sector, and we intend to stay that way.
Charlie, would you pick up a stock like Chevron, even with the risks around lower oil prices and energy stocks right now, because Mike Wirth is prioritizing the dividend?
Yeah, I think you have to be very careful. So the energy industry is one that may not look the same on the other side of this. You at CNBC have done a nice job of covering the energy war, but that's a separate problem here with Russia and Saudi Arabia in their dispute. Some people think that the Russians are doing this on purpose to squeeze American oil producers. I think that business on the other side of this does not look as good as it was 4 or 5 months ago, and they should not, frankly, in my opinion, be paying the same dividend that they were 4 months ago.
Mike, to that point, in normal times, for certain companies, a cut in the dividend is a terribly bad red flag that they want to avoid at all costs. But it seems like the market isn't reacting that way to the companies that have cut their capital return programs, and therefore perhaps there's a bit more leeway than typical, and it might serve to be prudent as opposed to sticking to your guns.
Well, especially because the market has rushed ahead to price in some pretty bad scenarios for a lot of these companies already. So it doesn't typically have come as a surprise when they finally do decide to, halt a buyback or cut the dividend. And you also have a stock market, keep in mind right now, where, we've been swinging 4, 5, 7% a day. So the idea of, compounding a 4% or 6% dividend yield isn't really the game at the moment. So I think when a company says we're going to conserve capital and that's going to help us make it through this period, that's a net positive as opposed to kind of taking away some of the goodies that investors were looking for.
Now, Starbucks CEO Kevin Johnson called into CNBC earlier. He talked about the fallout from coronavirus and progress in China, where many businesses say they are slowly returning to operation.
We have been dealing with COVID-19 now for 9 weeks in China. And throughout that entire 9-week journey, we have sort of learned the playbook, and we've learned the curve in terms of when you shut down, what happens to consumer behavior, and as you go through this, what happens when you start opening stores. And we're on the uptick in China.
Are you encouraged, Charlie, when you hear someone that has had experience of this process in China and had a relatively optimistic outlook that we will get there here in the US? Yes, it'll take a little bit more time and the worst is still to come, but was optimistic that in 2 months' time we'll be on the other side of this.
Absolutely. In fact, I think that's the thing that's given us the most confidence, is that we've seen that you can bounce back from this virus relatively quickly. We obviously saw the same thing in South Korea. Now, of course, Italy gave us pause on that scenario, and New York is behaving a little less well as well. But we do fundamentally believe that China shows that with a dramatic downturn in the economy, which they had, you can come back relatively quickly. And it's not just because the Chinese government is saying that. We're hearing from our companies and management teams that their Chinese suppliers are almost back to full capacity, which frankly happened faster than we thought it was going to.
We're at session highs, up 2,033 points right now on the Dow. If we close around these levels, that's the biggest point gain ever. Now, here at CNBC, we also spoke to Coca-Cola CEO today, James Quincy. He told us how Coke is preparing the company and employees for an economic downturn.
Q2 will see a profound economic shock around the world. We've got to be able to adjust our business, and we have lots of variables, and we follow our capital allocation model in a way. You know, we focus on prioritizing the organic business and the dividend, and then M&A and share buybacks at the bottom. So we want to keep our skilled employees because we believe there'll be a rebound.
So, Charlie, how do you think about the consumer staples right now? They're the worst performers today, but still having a good day, and they've been outperformers in this volatile period. A company like a Coca-Cola has a dividend, and people are rushing out to groceries to stock up on the basics.
Yeah, these stocks, these companies' businesses have been very robust here. We own a lot of Smuckers, and they're selling peanut butter as fast as they can make it. They're going to have a great quarter. There are not a lot of businesses that are going to do actually better this year than otherwise would have been expected, but some of the consumer staples, Smuckers is the one that we like the best because it was trading at 13 times earnings going into this. Coke and Pepsi were trading at 21 times going into this. So we don't love some of the consumer staple stocks because they were kind of expensive, but there are some that are both cheap and going to do very well.